Most people watching Nvidia focus on one thing: why the stock has moved so slowly this year. But what will shape the company over the next 2 to 3 years has already happened, and the market hasn't fully priced it in. Today, I'll break down those overlooked shifts. Hey everyone, welcome to Stock Market Breakdown. Lately, the conversation around Nvidia has become extremely polarized. Some think the stock can move higher, while others believe it's already too expensive and risky. But if you look closely, most of these views are driven by price action, not by what's actually changing inside the company. In this video, I am not talking short-term trades or price targets. I want to clearly explain where Nvidia truly stands right now. If you zoom out and look at Nvidia over a longer time frame, it becomes clear that this company is fundamentally different from what it used to be. Nvidia is no longer a business that lives and dies by the consumer graphics card cycle. It has fully transitioned into data centers and AI infrastructure. More than 90% of its revenue now comes from data center operations, and what it sells isn't just individual purpose, but an entire system compute, high-speed networking, interconnects, and a software ecosystem builder (NVDA). Once customers adopt this full stack, switching away becomes extremely costly. That system-level lock-in is where Nvidia's real moat comes from. So the first step to understanding Nvidia isn't asking how much higher the stock can go. It's acknowledging that the company's business model has fundamentally changed. Today, Nvidia looks far more like an infrastructure provider than a traditional high-growth tech stock. If you keep analyzing it using the old graphics card cycle mindset, it becomes very easy to misjudge both the company and the stock, and just as easy to get pulled around emotionally by the market. Looking at the most recent quarter, Nvidia posts $57 billion in revenue, setting another all-time record. With nearly $10 billion of growth quarter over quarter, a lot of people immediately worry that this means the business has peaked. But the real question is where that growth is coming from. Data centers continue to account for the vast majority of revenue, and demand has not meaningfully slowed. Gross margin dipped slightly from 75% to 73%, but the company guided next quarter to $65 billion in revenue, with margins returning to 75%. That points to short-term delivery timing and product transitions, not any underlying demand problem. That's exactly why focusing only on gross margin or single-quarter growth numbers can be misleading. What really matters is whether order structures are changing, whether customers are delaying or cutting long-term plans. So far, there's no evidence of core customers pulling back. Instead, what we're seeing is longer-term, more systemized compute planning, and that's a critical signal when evaluating Nvidia. Valuation is impossible to avoid at around 38 times forward earnings. Nvidia doesn't look cheap, but valuation only makes sense when viewed alongside the growth path. If you treat AI as a short-cycle theme, then today's price may look expensive, but if you accept that global AI infrastructure spending could grow from several $100 billion into the multi-trillion-dollar range over the coming years, Nvidia's position in that ecosystem makes it very difficult to simply label the stock as cheap or expensive. A question I hear all the time is whether Nvidia can double again. The question itself comes from a trading mindset. What actually matters more is whether the market continues to revise Nvidia's revenue and earnings expectations upward over the next 2 to 3 years. As long as the process continues, the stock can keep moving higher even without valuation expansion. One of the biggest mistakes the market is making right now is analyzing Nvidia through the lens of a traditional semiconductor cycle. In the past, chip companies would sell through one generation and then wait for the next. Today's data center orders are part of long-term planning cycles. Customers aren't buying a few chips to experiment, they're mapping out compute capacity for years ahead. As long as that trajectory remains intact, short-term inventory, delivery timing, or margin fluctuations are mostly noise. That's also why the stock can trade sideways at high levels without breaking down. The market is digesting prior gains, while still being unwilling to dismiss the long-term thesis. This kind of consolidation phase is typical at elevated levels and is often where investors feel the most uncertain and make the most mistakes. Competition is frequently brought up author chipmakers, in-house silicon, custom solutions, but real competition tends to show up at the margins, not at the core. For customers that have already built their AI training stacks on Nvidia's platform, switching costs extend far beyond hardware pricing. They involve architecture, software, and teams. That's why Nvidia has been able to sustain high margins for so long. It's not selling a single chip, it's selling a system. That's extremely difficult to replace. So short-term margin fluctuations don't mean Nvidia's moat is weakening, as long as its system-level advantage remains intact and customers' long-term plans stay in place. Changes in pricing or timing won't undermine the core thesis. Policy developments have also forced the market to reassess worst-case scenarios. Previous restrictions clearly impacted revenue. Allowing the sale of specific models represents a pragmatic compromise. For Nvidia, these are high-priced products. From a policy perspective, technological gaps remain in place. Once the most extreme downside scenarios are taken off the table, the market tends to reprice expectations well before the data fully shows up. Another factor that's often overlooked is geographic demand. Right now, large-scale AI investment is concentrated mainly in the U.S., but globally, many regions are only beginning to discuss infrastructure build-outs. That suggests demand isn't peaking, it's spreading outward. That's why Nvidia's results are often questioned, even as the company continues to outperform expectations. It's not that the market lacks intelligence, it's that the pace of industry adoption is extremely difficult to model linearly. By the time confirmation shows up clearly in the data, the stock has often already moved. The real opportunity usually exists, while that perception gap is still closing. So if you ask me what stage Nvidia is in right now, I wouldn't call it cheap, and I wouldn't call it a bubble. I say it's being repriced. The market is gradually shifting from imagination toward a more grounded assessment. As long as AI infrastructure continues to advance, and Nvidia maintains its system-level position, time may ultimately prove to be its biggest ally. This is Stock Market Breakdown. I'll see you in the next one.